You see my trading,
Yes, sir.
it was magnificent. Uh, as usual, per usual. Um, I think that what I kind of understand about trading is the more time that I spend doing this, just the better it gets. And I think coming into trading, you have a false uh, sense of how things should work. Like you think things have to be clean, um, and they don't. That the truth about trading is you're here to make money, and many times it's not going to be it's not going to be clean. You're going to take some L's en route to your W's. Um, so I think if once you understand uh, how to clean up messes or how to, let's say you get in the trade and you end up becoming a liquidity sweep. Whereas in the past you might just chalk that up as an L, and you move on to your next trade. As you have the experience, you kind of understand what's going on. Okay, they caught me slipping. Now you get back in, and you can not only recoup that loss, but you can turn it into crazy gains. Um, for whatever reason, it just seems like the the market has just opened up. Like I see everything. I don't know, like in 3D, and you know, um, their profits are ridiculous. So, uh, like where is in the past, I might have been cool with 5K or something like that, but I'm really to the point where I'm kind of expecting 30 or 40K months, and it's not because I'm overly cocky. It's because I have a lot better understanding of what I'm looking for. I can anticipate all of these moves instead of reacting to the moves. And it's kind of we go back to August 5th when I was telling everybody what I thought about those wicks, right? And I got a lot of pushback, and it's funny, but it's not funny. But I mean, I get it, right? I got a lot of pushback um, about the wicks because they were just wicks at that time. But the truth is, had I not saw those wicks or had I not been paying attention, um, I would have missed a lot of money. I was able to make a lot of money on these moves, right? Because I'm not reacting. I'm anticipating. This is the wick. It pushed down. This came right back up here. I remember um, me and the Boo thing getting in this trade on a Friday. On a Friday, guys. And in the past, I wouldn't have. Okay, if I get in on a Friday, I expect to move and maybe get out on a Monday, right? But we got in this trade on a Friday. Maybe it was right here. We got in this trade on a Friday, and look at this. Look at this crazy drop. So I was able to catch the entire drop right down to my zone, right? And then the next day, right? The next day, for that whole week, we caught that trade. The next day on the Sunday, the trade comes out and buys up. I got in about halfway through this buy on that Monday, like on London shift. I got in, and I was able to ride this trade all the way back up. That these are moves that in the past maybe I catch fractions of, or I'm not really paying that much attention. But because I understood what that wick meant, I could catch the whole ride down, the whole ride back up. Now I didn't take this portion of the ride down, which I probably should have, but I didn't take it because I was in a Euro Chef and I want to say EA or GA, but you know they're similar. But if you can catch these moves, these moves right here change the whole. They can change your trading year because the amount of money you can make in a push down and a pull up, right? The amount of money you can make is absolutely ridiculous. And then once you're on top, you can be very selective about your trades, and you only take the trades that you believe in. And you know, I know y'all will probably laugh at me, you know, but when I pull up these line charts, I do this stuff for a reason because some people are lost, man, and this doesn't lie. It just doesn't. Whenever this push down right here came down and broke this low, a lot of people gave me pushback. Hey, man, that's internal. Then the market comes back and look, this high doesn't break this high. It doesn't. And the market turns it and melts like freaking butter. And everybody always like laughs or thinks I'm nitpicking. But if I put a line under the low of this, low right here, and you can look over to the right and you see that clearly this line is breaking it, that's telling you that the market is going to go lower, right? It ruptured this low, which means it'll probably push down to this area, to this imbalance, then it'll pull back and it's going to keep dropping the same way I told you it was going to keep dropping weeks ago. I don't want to be on a soapbox, right? Who cares? Just because I told you, ICT told me it was going to do it. That's where I learned it from. But my point is, the more experience you get, even if I had lost one of these trades, then I just get back on the horse. My confidence is not shaken. You know, it's going to happen because that's what that meant, you know? So if you have errors or you make mistakes during this run, you just say, okay, I made a mistake, but I still understand what's happening in the market. And to me, that's the biggest, most elusive truth about trading is it doesn't have to be clean, right? Like you can get tricked, but still be right. As long as you hang with the move and you don't over leverage, right? Over leverage is the root of all evil. Because if you don't over leverage, right? If I call this as a sell and you got in this trade, as long as you didn't over leverage, there's no way that you could lose. No way. Because anytime you would have gotten this trade, right? If you would have put your stop loss above that wick, I don't give a crap where you got in this trade. You could have got in right here. You would have went and draw down. You'd have been in profit. You came back, went and draw down. You'd be in profit. There, you can't lose because the trade is definitely selling. So to me, that's the big joker when it comes to trading. And you know, another thing that people don't really appreciate is these higher time frames are where the real money is. It's not on the 15-minute chart. And it can be. I get it, man. You can get on a 15-minute chart. You can make money real, real fast. But nobody ever talks about you losing that money real, real fast. But to me, the absolute huge money is on these higher time frames because they don't lie. They don't lie. And if a higher time frame does a fake out, you have so much time to correct. On a 15-minute chart, if it fakes you out, man, you got 15 minutes. You can't course correct in 15 minutes. But if this is going to be a fake move on the weekly, I got the whole week to rearrange. Does that make sense? Hopefully, you know. Hopefully
yes, it does.
Get it.
Yeah.
Yeah, it makes sense.
Makes a lot of sense.
Yeah, I just think that you know, if you're serious, you know, about trading and it changing your life, man, you get with people who have had the success, right? And you don't have to emulate everybody. You can take bits and pieces, you know. Those of you who have been doing this for a while, you kind of have an understanding of what works for you. But don't be a fool and feel like, well, you know, I can't learn anything. Or I can't adapt anything to what I'm doing, right? Because if you didn't believe that this was selling when we were way over here, right? Now you see basically an M. You see a leg up. You see a pull down in the middle. You see a double top, basically. And this drop, where's this drop going? We're just getting to the neckline where they used to tell you that you should start trading this once it breaks this neckline. Remember, y'all? Do y'all remember that? Them telling us, hey, man, you get in this M pattern once it breaks the neckline. I done made 30K already up here in the hump. You know what I'm saying? So I'm not saying they're lying, but there's a lot better way to do it. But now that we're at this M, right? Now that we're 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks after I originally said it was selling, we're 9 weeks in. Now it's believable. So, you know, in my opinion, if I told you it was going to sell 9 weeks ago, and now you're just now seeing it, I got to go back to the drawing board as a trader because I want to see it 9 weeks ago, like this dude saw it 9 weeks ago. So, look, guys, all I'm saying is there's huge money in trading if you're willing to put in the work. If you're willing to put in the work. And you know, the funny thing about trading, and when I look at this chart, I know it's kind of all foolbar. Let me just delete all the stuff on it. But the funny thing about this trading is trash. Is whatever I told you. Remember how we get on the end of the month, and I say, hey man, whenever we get that close below the moving average, you wait for that retest, and then it's time to get in. Well, here we are on the weekly chart, and we got to close below the moving average, right? This was the initial close, right? But it wasn't really below the moving average, but you got to pull back, and now we're selling. But you get your close below your moving average. This take of liquidity, it took out these highs, tells me that we need to target this low right here. So even if you're late to this party, you're coming to this party late. This is a 735 pip drop that I'm anticipating. Now, we got to pull back first. So it'll probably be about an 800 pip drop. Man, you can do a lot with 800 pips. You can do a lot. You know, 10, 15, 20, 30, 40, 50 grand with these types of drops, because every time it pulls back, you doubling up. But it just depends. You can't be aggressive in trading if you have no belief in what you're seeing, right? You can't be aggressive until your grade A setup comes. And for some of you, you don't have a grade A setup. And I just suggest that you start paying attention to the setups that you really believe in and you really like, because, you know, chances are those are your grade A setups. And when you get those setups, to me, you can go heavier on those setups than you can on a regular setup. And then once you get you a nest egg built, then you're only taking the grade A setup. You're not taking any 50-50 trades. You're just saying, hey man, I'm only taking grade A setups. And maybe you don't see the market like me, or you still don't believe like me. Maybe you believe like a Kim, right? Who's only going to buy until it starts selling. Maybe this is just the first sign that, hey, it's starting to sell. And I don't believe it's going way down here. There's an imbalance right here that is going to. So I'll wait for a pullback and I'll trade it to the imbalance. All that stuff is great, man. Like this might be a zone for somebody like Kim. And you're saying, I'm not touching it until it breaks that zone because it's going to bounce first. If it breaks that zone, I'll wait for a retest. However you see it, you know, I'm not saying don't trade like an Andrew or don't trade like a Kim. You know, trade however you trade. But what I'm saying is, if you can see it on a higher time frame, it gives you a lot more opportunity to trade that thing on a 4-hour or on a 1 hour, whatever time frame you're actually making your moves on. Because now you understand that the higher time frame is cascading to the downside. So any signal I see on a lower time frame that confirms that higher time frame, it's probably going to be a landslide trade for a little bit. If I got bearish weekly, a bearish daily, and a bearish 4 hour, as soon as that 15-minute goes up and gives you that bearish order block, I can get in it, and I might catch 150, 200 pips. All right, but anywho, any other questions before we get into the part 2 of this market structure video? For those of you who are trading those JPYs to the upside, just be careful, bro. Be careful. There's great opportunity, but you know, when you look at the line chart, the line chart is telling you that you might be approaching a little danger, and approaching is a broad term, because I mean it might be 400 or 500 pips, but those JPYs move a lot of pips very, very fast. EC is looking better. Hey, Kai, I'm glad you feel like it's looking better, you know, about 6 weeks after the move. But you know, it's all good. You see it when you see it. Eurochef, you know, Eurochef has been bullcrapping, right? But the thing about Eurochef is we saw it. You know, we saw that wick. We saw the wick take the low. We saw it. That's undeniable. That wick took the low. And it was really after this push up that broke these highs. It was after the push up, after the chalk, the pullback, we ran the low. You know it's going up. Now, it might be frustrating that it's not going up fast, right? And a lot of y'all looking like, well, Todd, that's a bearish order block. And we just tapped back into it. And I'm like, okay, that's cool. But on this 2 week, it's a bullish order block that we tapped into. So, you know, you have to decide whether the 2 week or the 1 week is going to win. I'm telling you, I'm in it, and I've shaved off most of my hedge that I was in from this sell down, but it's looking great, and I expect for it to continue to look great. And you know, this is the next imbalance that I'm targeting. That's about 300 pips away. So if we roll up to this imbalance up here, bro, this right here is a 300 pip move. Now follow me on this. If you have a $100 account, you can trade you can trade up to a 0.30. I don't suggest trading a 0.30 as a rookie, but you could trade up to a 0.30. But if you traded a $1, a 0.10 for 300 pips, you're going to make 333 bucks on this 300 pip move. And your account will be $433, right? If you trade a 0.20, right, for 300 pips, you're going to make about $666, and your account will be $700. This is just basic math. If you have a $1,000 account and you trade in one standard, you're going to make about 333 bucks, and you'll have a $4,000 account. You could trade two standards, and you'll make $6,666, and you'll have a $7,000 account. That's just basic math. However long it takes, I don't know, a week and a half, 10 days, 4 days, however long it takes to get up there, those 300 pips. But the move, if you believe in this, if you believe that move is going to happen, and you just put your TP there, you're going to get paid, right? Just like that EC trade. If you believe in the move, then you're going to trade it, and it's just going there. And you can put the lot size in, and you can go to sleep, even if it takes 67 days. And I would ask you this: how much money have you made the last 67 days? Not you personally, but the group. And if it's zero, then you don't have nothing to lose. You don't have nothing to lose. So however long it takes, length should never be an issue, because at the going rate, you're not making any money anyway. So if you can see a move where you can make the money, um, um, I would suggest that whoever is in that situation, whoever's in that predicament, if you see a move, right, there's a bullish order block, we got the tap in and it's now pushing up. If you see a move, like you see that this is going to push to this area, however long that takes, whether it's a week, 10 days, 67 days, you have to look at your last week, your last 10 days, your last 67 days and say, hey, man, did I make X number of dollars? If the answer is no, then a change might be in order for you. And you might just do what somebody else's suggestion and come up on these 242 pips or whatever. You know, if you trade this one or if you trade whichever one you're trading. My point is, deny yourself your guilty pleasure of you needing to be right and allow somebody else's correctness to get you paid. That's all I'm saying. And even if I zoom out of this, dang, bro, there's a push down, right? We break all these lows. The market is rounding off. It could be any level of Wyckoff that you want to. We all know that this is coming back up. Even if it just came back up to this imbalance that we can clearly see on this 2 hour. I mean, this 2 week chart. We all can clearly see an imbalance that everybody in here to a T would say needs to get filled, right? Everybody in here is smart enough to say, man, this market pushed down, we broke structure. Now it needs to come back up to this imbalance. So the market is sitting on the floor right here with a bullish order block pointing to this imbalance that is 600 or 700 pips away. So every clown, every donkey, every whatever other name you want to call them, that has been trading and throwing away their money, everybody sees right now this 650 pip move that all of us are capable of capitalizing on from where it is right now. Whether you do it or not, that's something that's totally different. It's totally different. This move right here, this push up, if you look over here, we broke structure. We broke that structure. Then we pulled back down. Damn, bro. Like if you fib this move right here and the pullback, everybody sees the optimal trading entry. This even pulled back probably 88%. Now it's going up. You can't get any more simple or any more rational than that. I mean, does anybody
any more textbook than that?
Yeah, does anybody see it? Does anybody want to argue that that's not what's going to happen? And if the
then
answer
it tapped
no,
right into the 2 week,
bruh, it was perfect. So all this is what I'm saying. Once you stop lying to yourself and trying to make the narrative fit to what you're trying to squeeze it into, and you just look at the damn chart and it's telling you, hey man, here's a 600 pip move, bruh. If you've not made any money, why not now? Why not now? Why not you? Why not now? Even if this took until December, just imagine what kind of Christmas you can have. We already talked numbers, as Master P would say, numbers. $100 account, 600 pips. That's 600 and some dollars, man. You go $2 up here, right? You over $1,000. Mess around, have you $1,000 account, bro. You can go get that car. Go get you a whip. It's out here, man, every week, and it's in our face. So I just want everybody to be able to take advantage of it. And that's how trading has been going for me. You know, I know you asked a question about an hour ago, LeVar, but it just, the experience has slowed everything down. And what I understand about trading is even if you saw this push up and you said, man, we broke these highs and it pulled back and you got in this trade and started buying and then the market went against you, all you got to do is throw in a hedge. Yeah, it took time for this thing to start turning around. But your experience told you, I know this thing is buying. I know it's buying because it went down, it pushed up and broke these highs, pulled back. You might have been wrong. It might have faked you out here because you thought it was going down to the 78, but it started buying to induce you and you got in. You just throw your hedge in. Now, when it comes down to history of 78, now you kill that sell portion of your head. So you made a lot of money going down and you let this negative equity grow positive. And if you have a little bit more experience and you're a little bit smart like me, you'll just throw you an extra buy position. You see what I'm saying? So anyway, I don't want to beat a dead horse, but the opportunities are all around us. You know, they really are. Every week, every day. And some people figure it out a little bit faster than others. And then they share that, man. This is a free group. So, you know, even if the way I trade doesn't relate to you, maybe the way Kim or Andrew or whomever, TT, maybe the way that somebody else trades speaks to you. And it's all good. You know, I just want you to be able to make that money. And then maybe the other people who are having success, you know, they'll come forward and share what they do. You know, like maybe LeVar will share more in advance than after the trade. So, look, man, we just encourage, you know, to share whatever you're doing to beat the market on a daily, weekly, or whatever basis, right? And maybe you're able to articulate it in a way that speaks to somebody else in the group. Whereas the way I articulate it might offend them, or it might turn them off, or they might not be able to follow. Maybe I'm too risky. Maybe my time frames are too high, you know. But all I'm saying is, you know, for me, I've tore out the days. I tell my girlfriend all the time, hey man, don't ask me how long it takes, because it doesn't matter. At the end of the day, it doesn't matter. I don't have a job. You don't have a job. Trading is your job. So if it takes 2 weeks, so be it. If it takes 2 months, so be it. You don't need the money. You don't need the money. So, you know, that's where I am as a trader. I don't care how long it takes. I just care about winning that move. And you know, it is what it is. But today I wanted to take part 2 of this market structure video. I know we watched part 1 last week. Part 2 is a little bit longer. And I've been on the soapbox for about 30 minutes. But you know, the longer you or the better you get at trading, and the better you understand market structure, the better your trades will become, and the better your setups will become. So if I don't have any more questions, we'll jump on this part 2 of this market structure video with your boy Pips.
Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face, and I hope you're catching Pips as usual. Pips of Persia here, finally with a new video. But firstly, I want to thank everyone for 20,000 subscribers. Wow, our community has grown so huge, so quickly. So big shout out to everyone who's subscribed to this channel. And I hope you continue to get value from the videos. And secondly, I hope you have your notepads and pens ready, because honestly, I'm not going to waste any more time. We're going to go ahead and jump straight into the charts and start the second part of market structure. And you know the drill. If you get value from the video, do make sure to press the like button down below. And if you're new to the channel, make sure to press the subscribe button and turn on post notifications. Welcome to our family and welcome to our community. Also, do make sure to stay until the very end, because I might just have a surprise for you guys for part 3 and the final part of the market structure series. So in the previous video about market structure, we covered a few topics such as a bullish trend and how it looks, a bearish trend and how it looks. And not only that, we also spoke about trends within trends. For example, you can see smaller trends within larger moves. And we also spoke about how to not mistake a larger time frame pullback as a lower time frame break of structure and start to take the wrong trades. To remind you what that looked like is the idea that on the higher time frames, you might have a trend that looks something like this. However, on the lower time frames, it goes without saying you have trends within trends. And in this case, your trends within trends looks something like this, give or take, right? So the market crossing below these structure points over here, we can't necessarily consider this a higher time frame break of structure. Yes, guaranteed, maybe on the hourly time frame it broke structure over there to the downside, but that doesn't necessarily mean this market is going to turn around completely, especially on the higher time frame, and start going down. Long story short, what we spoke about is the idea that for the higher time frame to break structure, you would need a break of structure on the lower time frames first. However, just because we are breaking structure on the lower time frames, that doesn't necessarily mean that's going to happen on the higher time frames as well. I'm not going to spend much longer on this, especially because that was the entire idea behind the previous video. But just to again quickly refresh everyone's memory, this is another example of the same idea where on the lower time frames you can see your step-by-step trend. On the bigger picture, this is your entire move. That's one wave to the upside. As you can see, that's the bigger trend, the yellow circles. And just because the market has now given you a pullback and broken below these lower time frame structure points, that doesn't necessarily mean it's going to reverse on the long term, because it's broken the lower time frame structure points, not the 4-hour or the daily ones, for it to end up giving us that massive retracement. Now we're going to pick up exactly where we left off in the previous video, and one of the final things that we spoke about is how do we know when this retracement is going to stop, and how do we know when it's going to reverse? In other words, a lot of you find it easy to identify your major higher time frame trend, and you can identify that and see that perhaps it's in a bullish market. A lot of you also find it really easy to identify the smaller structure points within the same trend on the lower time frames. So you might even be comfortable looking at the fractals, looking at the smaller trends that take place within the larger trend. But you might still be struggling because you still find it difficult to understand whether you're going to get a shallow retracement over here or whether you're going to get a deeper retracement. You might still not know exactly where you should be pulling the trigger, where you should be entering yourself in the trade. Just before I give you the solution to this question that you've probably been asking for a long time, I need to mention a couple things. The purpose of what I'm doing on this channel is a lot more than just educating the masses. I want to challenge the way that you think. I want to challenge the way that you approach the charts. And I want to help everyone look at the financial markets from a completely different perspective and start to analyze their charts and manage their investments in a much smarter way. So what I'm about to say will challenge the way that you think and will challenge the way that you have been looking at the charts and perhaps analyzing the charts. But it's now down to you to not overanalyze it, to not overdo it, to not overcomplicate it for yourself and in a way confuse yourself using this concept. This will most definitely help you with top-down analysis. In a way, it will teach you even how you can confidently go from one time frame to the lower time frame. And it's one of the final directional confirmations I would use in a way that if I see this, I'm certain on my direction, and the only thing I would worry about after that are practically entry points. But I have also seen people overuse this and overdo it on a lot of different time frames, which will result in overanalyzing a pair, which will result in stop losses being hit. So pay close attention to what I'm about to show you now, but it's down to you to figure out how this is going to be implemented in the trading strategy or the trading plan that you have already defined for yourself. And this is where I'm going to challenge your thinking. We have always seen and always been taught and have always done this, and this is even something that I have done a lot in my trading journey, to always pay close attention to the final swings that take place in your given direction and always look at points of interest on that given swing. And don't get me wrong, this could very well be valid, and this is something that we do on a daily basis. You know, we have the trend, we have the swing, we find points of interest within that swing. But here's the thing. If I'm not even confident, fully confident that this is going to give us another push to the upside, what's the point of me finding these points of interest? It makes no sense, right? That's why I was talking about a final directional confirmation, because people get way too invested trying to identify their points of interest, but they haven't even got that final directional confirmation. You're looking at where to enter, whereas the market still hasn't even confirmed that it's going to go in your desired direction. So for a while now, instead of me paying very close attention to the points of interest on the left-hand side over here, don't get me wrong, eventually we have to use some type of a point of interest on the left-hand side to actually execute the trade. But for me, when I want to get fully confirmed on the trade, when I want to figure out where this retracement is going to reverse, I don't necessarily want to pay too much close attention to the points of interest over here. And this would mean I'm not really interested in sniping the trade at the very bottom over here. That would mean I would have to wait a little bit to get my confirmations, but you best believe the trades that I'll end up getting in will be much more confirmed, which means on the scale of things, I would have much higher probability with the trades that I'm executing. And this is where fractals would come into play. This is where everything you've learned in the previous video is now going to help you with analyzing charts better. As discussed before, there's a lot of trends within trends. We have your trend within trend as an impulse and as a retracement, as an impulse and as a retracement. There's trends within trends for all of this. So when we are experiencing this next big retracement over here before the next impulse, it probably makes sense to start to see lower time frame market trending in the opposite direction. So instead of me trying to choose between these points of interest and trying to figure out which one the market is going to bounce off based on, all I do is I mark up my points of interest and I go to the lower time frames and I pay attention to the market structure on this pullback. I pay very close attention to the lower time frame market structure on this pullback, and I would only be interested in executing the trade when I have my final directional confirmation, which is a break of structure in our desired direction against the minor pullback, or against the structure on our pullback, the minor counter trend structure within our pullback. And the reason why I pay attention to this is because it gets rid of a lot of unnecessary questions that tend to distract a lot of traders. What I mean by that is obviously within this impulse to the upside, you're going to have trending market as well on the lower time frames. So when you start to look at the market from this perspective, this break of these structure points to the downside are not necessarily going to worry you anymore, because you're paying close attention to another lower time frame market structure, and you just want to take the trade based on this pullback, based on a break of structure of this pullback. So all of these little structure points being broken are not going to throw me off. And not only that, my trading becomes a lot less stress-free, because when I start to observe this type of trend over here, all I need to do is set my alert. Once the market breaks the structure point and my alert goes off, that is when I would look at the chart and I'll start to pay very close attention to what has actually taken place over here within that break of structure and start to look at my points of interest within that range. The reason why we do this, some of you now might be confused because you might think to yourself, hang on a second, over here, you're still looking left to find your point of interest. You still might have that issue of, am I going based on this institutional candle or this institutional candle? But what you need to understand is we are limiting the amount of information we are analyzing. We have gone potentially from, let's say, a 200 pip swing to maybe a 50 or 100 pip swing. It's a lot more limited, the area that we are looking at. And if we continue to do this going lower and lower and lower, you'll end up looking at very small risk. So it doesn't really matter which institutional candle you take the trade based on. And not only that, within these scenarios, you will find that your entries are a little bit less confusing, as you are simply looking for the area that sponsored this break of structure. I'll say that one more time, not going to elaborate too much on it right now, but you simply would want to find the area that sponsored the break of structure. Quickly, I want to cover this from a supply and demand perspective as well, just so it makes a little bit more sense why this actually takes place and why I use this as one of the confirmations. Something important to understand is just because you can't identify an accumulation or a distribution doesn't necessarily mean it doesn't exist. For this market to turn around and go up, it must have accumulated down there, even if you can't see it. For this to reverse and come back down, it must have distributed up there, even if you can't see it. Which means when I'm looking at this trend and I'm waiting for my directional confirmations to then be able to take the trades, it's obvious that up here, we have an area of distribution. That's where supply was introduced to the market, pushing this back down. Now, if this supply is sufficient enough, this is going to start to break lower and lower and lower. The trend would normally start to be respected properly. You will start to get more aggressive and longer swings to the downside and would end up breaking the major structure points to the downside. But now we want to use the same analogy to see if it's a lot less likely to break lower and a lot more likely for it to reverse and go back up. And the idea behind it is on the lower time frames, all of these areas can count as minor supply. Minor supply. All of these can indeed count as minor supply. The same way down here is now a demand area, an area of accumulation where this has reversed. These are all minor supplies up there. So once the market starts to challenge these structure points, that means it has now completely violated that area of supply. And if it does the first one, it might be likely to continue to violate the next areas of supply as well. These are normally when I would pay attention to accumulations that would take place over here, to the type of price action that we would get as this market is reversing and breaking structure to the upside, to kind of make sure that we do have strong elements of demand. Indeed, we have introduced a lot of positions in the market. Again, you can start to see these by the strength of the move. And by that, I mean how quickly we've moved away from a specific level, and you can also see these by breaks of minor or major structure points. Never thought I would be using this documentation or this screenshots, especially because it was taken quite some time ago, but I guess this actually kind of applies in this specific situation right now in terms of that supply and demand that we were talking about a little bit earlier. There's not much information on this chart. This was a quick documentation for myself just to see this previous areas of demand on GBP USD from end of last year, and that was when I wanted to see if GBP USD does have the likelihood of having another massive leg to the upside, or whether this is going to be the complete reversal for GBP USD. So similar to what we spoke about before, this was our little counter trend market under retracement from the high to the low. So that's our high over there, low, lower high, lower low. This broke that structure to the upside, created a new structure point in the market. So now we have kind of that directional confirmation. And something that was really interesting to see over here on the FXCM data feed was this range down here that was created, because there was a few factors that kind of added together. Number one, this move to the downside was a manipulation of a lot of previous lows. So it definitely tapped into a pool of liquidity, which in itself can qualify as a zone of demand or supply. Number two, it moved away from that level extremely quickly. We actually gapped over the weekend when it moved away from that level. So there must have been a significant amount of demand introduced down here. And not only that, it did indeed create a new structural high in the market. So this entire move, this entire rally was sponsored by whatever took place down there. It's not always the ultimate bottoms and ultimate tops that would sponsor the major move, but in this case it was. So that level down there is now going to qualify as an area of demand. We've manipulated previous lows, it's moved away from that level, it's created a new structure point, blah, blah, blah. So I shouldn't be surprised to see the market now back in this level, getting ready for the next rally to the upside. And looking at GBP USD, this was this exact scenario over here. So that was that gap, this was the level. This wasn't necessarily something that I traded, it was more so something that I wanted to see if this is going to, in a way, sponsor the next massive rally for GBP USD, which it did. That was indeed the beginning of a huge move to the upside. It might not have necessarily been sponsored by the final push to the downside over there. We did have some other reaccumulations, which I'll speak about a little bit later. But either way, we did have a final push to the upside. And this is that picture which we saw earlier as well. The yellow circles being your major structure points. And we can see as this low was being created, we had this counter trend market. It manipulated lows, it broke the structure to the upside. So later on upon this pullback, we could have looked for entries. Let's have a look at a few more scenarios, analyzing it from this perspective as well. Another textbook example is this low over here for GBP USD. Generally speaking, the major structure points would be that low over there, this high, and then potentially this higher low over here. This was also a move that in a way challenged some previous major structure points. So we did have an idea that potentially this could be the beginning of a bullish move. But I still want to now see those bullish confirmations, those final directional confirmations. So upon this retracement over here, I can start to look at some structure points on the lower time frames. I don't necessarily need to go to the 15-minute time frame to be able to identify the major structure points here. I know that that's a high, that's a lower high. This is another valid lower high, another valid lower high, and another valid lower high. So generally, my trend is looking something like this on the lower time frames, which means this is now this lower time frame pullback. This is now this lower time frame retracement, which upon a break above this, I can actually have my final directional confirmation. And that indeed is what we could have traded based on. A break above this level would have confirmed that structure is now on your side. You're bullish on the higher time frames, and upon this lower time frame pullback, you have now broken the structure in your desired direction. So look for entries. Funnily enough, structure at this point would have been more than enough to give us enough directional confirmations. However, it wasn't only structure. This is where you can mix everything else that you have learned from other videos, that you have learned from other courses perhaps. But again, this was a very textbook example. We've spoken about this many times before as well, because this was a manipulation of a trend line to the downside. And as it was doing that, as it was manipulating the trend line and to sponsor this move to the upside and a break of structure to the upside, we actually had an entire accumulation range. So now we have multiple different confirmations pointing towards the same thing. So we go ahead and look for entries. Also, you might think to yourself that I'm not talking too much about entries right now. That's because I'm saving that for this case study or for this quick trade analysis that we are going to go through together in literally a couple minutes. Before doing that, however, let's look at a quick final couple examples. This would be a nice move to cover from the same level that we were looking at just before. You can see through the yellow circles the major bigger trend, and you can see the smaller trend marked in blue, and the retracement is what I care about over here, marked in pink. So remember, I'm not too keen in trying to figure out whether it's going to bounce up here or whether it's going to bounce up here or whether it's going to come down to this imbalance and institutional candle. Quite frankly, I actually don't care where it's going to bounce up from, because either way, I just want to take the trade. It makes no difference to my life whether I'm in the trade at this level, or at this level. I know I want to capitalize off of this currency pair. I just want to have my confirmation. So I'm not going to waste my time trying to find a lot of entry points within this region. I pay attention to the structure upon this pullback over here. And this is an interesting structure. Some of you might just consider that a three-wave structure. Either way, it doesn't matter. It's the same thing. But now we have structure points that I can go based on. What do? We identify the last major structure point. And upon a break above that, we have now confirmed our direction. So this was an example that it didn't actually violate the previous minor trend. It simply stayed respectful of the other trend, created a minor counter trend upon this pullback, and a break above there was what confirmed the trade. So when it started to trade above there, this is where we can now start to have a look at entries, start to have a look at where we want to actually execute the trade. And again, it's quite interesting and entertaining to kind of see this picture repeat itself over and over and over again and give you a lot of different confirmations as it's doing that. For example, once we had the confirmation of the structure on our side, this market almost instantly, not exactly instantly, but within a short space of time, it went into an entire reaccumulation phase. So for those of you that might find it difficult to look at structure, you would have caught this trade based on Wyckoff. For those of you who would have found it difficult to look at Wyckoff, you could have caught this same trade using structure. There's a lot of different things and a lot of different ways that you would be able to actually approach this, a lot of different confirmations that it gives you. And surprise, surprise, similar to what we spoke about before, similar to what you saw before, if you're meant to be going in a given direction for a specific or for a long period of time, you should continue to get confirmations of the market moving in that direction. Meaning, if I should be expecting the next rally to the upside, exactly what took place, I would need to see elements of manipulation to the downside. Why do we need to see manipulations to the downside? Why do we need to see these lows or these trend lines being taken? Because that's where demand is being introduced in the market. That's where the liquidity is being taken, meaning a lot of people, a lot of institutions around the world are being taken out of their trades, which naturally releases more money in the financial markets, allowing the bigger players to open larger positions, which would make the areas of demand and supply a lot more valid. So I really do hope that this little nugget made sense, especially for you to know that you don't necessarily need to worry too much about your points of interest, and instead you can focus on the structure being on your right side and continue to move to the lower time frames doing that. And once you have your final directional confirmations, then you would be able to figure out where the major move was sponsored by and take your trades based on those levels. Now let's put all of this together and break down a trading scenario. But before I do that, I need to mention that this is actually an intraday scenario. So I always speak about what a swing trader I am and how, the positions that I take are more so on the longer term side. The positions normally I stay in for maybe even a few weeks. I still have positions open from beginning of this year practically. But this specific trade was very different to the normal trades that I would take. Number one, because it was an intraday scenario. Number two, because it was Friday. Normally when I want to, take swing trades, I don't necessarily like to execute them on a Friday, but everything was lining up for this specific currency pair. So I did indeed decide to enter myself into intraday scenarios. And not just intraday, this was actually a counter trend scenario as well. But I want to kind of go into information as to why this trade was taken and what was the analogy behind it and why did I even decide to go bearish in a bullish market, going against everything that I have kind of said and taught. But hopefully this will actually clear up a lot of things about how we can counter trend trade and how you can take advantage of all of the moves. So I can trade this to the upside and trade it back down, if that makes sense. And more importantly, how to hedge. And this would be specifically hedge scenarios as well. Funnily enough, these didn't start off as intraday scenarios. I didn't actually take these trades with the intention of having an intraday scenario, or at least a short term, just over the weekend type of scenario. I started these sells with the intention of hedging, with the intention of I want to sell this to later on look to buy it, but the buy confirmations never took place last week. Perhaps next week we'll get it. Whenever I get it, I'll take the trade. So since this is an intraday scenario, we're not necessarily going to be focusing too much on the higher time frames like daily, weekly, monthly, even 4 hour in this case wasn't necessarily relevant. This analysis was mostly on the hourly and below. However, funnily enough, we did have the higher time frame confirmation. So on the higher time frame, such as 3-day time frame, we did tap off a previous area of supply, a previous institutional candle at the top over here. So this indeed could have, sponsored certain moves back down. This could have sponsored a deeper retracement on the higher time frame for GBP USD, something that kind of we've been expecting a little while. So although the analysis wasn't based on the higher time frames, we did have some higher time frame confirmation as well. On the bigger picture, there's definitely a few things that I cannot ignore and I have to pay close attention to, because they could indeed make all the difference between the correct or the incorrect trade. It seems as though this final impulse that we have had to the upside on the hourly time frame, on the 4 hour, this is going to look very different. The impulse would start a lot lower, but at least on the hourly time frame, it kind of looks like the major impulse started from down here. This was the ultimate low that was created, and from there we've been trading above that level and continuously going higher than that level as well. So that was the most major low that was created. That was the first element of demand that we had over here. This is now proof of demand over here. So this in a way is where I can see that that demand is now being proven to me. Yes, okay, this is valid as a demand. We've moved away from that level. And it looks as though this entire range can be classified as a reaccumulation range. And this was interesting to see, because in a way, this is a simple rally-based rally formation on the higher time frames. I know a lot of you trade supply and demand based on your rally-based rally or drop-based drop formations. Practically on the lower time frames, this is a redistribution and this is a reaccumulation. But in these contexts, reaccumulation, redistribution, rally-based rally, drop-based drop, institutional candles, doji candles in the middle of range, all of these things are identical. They are all pointing towards the same thing. So whichever one of these concepts you've been trading, you're definitely doing the right thing. As one of my good friends once explained, it's the same car crash from multiple different angles. But either way, this reaccumulation over here was quite interesting, because it looks as though it was actually this reaccumulation that sponsored the final move to the upside. It wasn't necessarily the demand down here. It could have been, but I'm not necessarily going to take into account this demand all the way down here. First, I want to take into account this hourly picture, this hourly structure, this hourly push to the upside for multiple different reasons. And we did speak about some of these, such as manipulation of the lows, a break of structure to the upside, and the market moving away impulsively to the other direction. So now my attention is a little bit more towards this final hourly impulse. Why? Because this seems to be the more attractive one. And I know I'm in a bullish market. So I know that the higher time frame is still bullish. So I'm not actually right now looking for sells. I'm actually looking for buy scenarios. And when I look at this final hourly impulse, this is where the problem begins, right? Because you can see imbalance over here. You can see maybe another unmitigated or an imbalance down here. You can see another imbalance over here. You can see it's another imbalance and unmitigated institutional candles down here. You now have 4 different points of interest that you can potentially buy this based on. And it becomes scary and it becomes difficult. You might not necessarily want to take 3 losses before you take the real trade. To avoid all of this confusion, now I'm not necessarily paying attention to these imbalances and to these institutional candles and to these points of interest. I don't really care about that just yet. First, I want to see my directional confirmation, meaning what? When I'm getting this pullback over here, first, I want to see a break of structure to the upside. I first want to know for a fact that this is the bottom of that pullback, and this is indeed going to reverse from there. So naturally, that's exactly what I will be waiting for there. And then I'll probably be monitoring the 15-minute time frame in this case to be able to see the pullback a little bit easier. But most definitely, this pullback over here would be what would draw my attention to it, would be what interests me to be able to later on potentially find entry points based on it. Now, for those of you who might still be confused what we mean about a hedge scenario and why we would want to hedge and what hedging generally is, The idea of a hedge is when you buy and sell the same asset at the same time, where it doesn't necessarily mean you would execute a buy position and sell position at the same time, but when at one given time, you're both in a buy scenario and a sell scenario for the same currency pair, for the same asset class that you're trading. And, you know, for some people, this makes sense. For some people, it doesn't. Some people think hedging is a good idea to kind of protect your losses. Other people believe hedging is actually worse because you're taking more risk on your account and blah, blah, blah. I don't want to give any more attention to opinions. I'm here to talk facts. And the fact is, if you know how to hedge correctly, you will most definitely decrease your risk because you will cover the risk that you're about to take before you even execute the trade. And this is the idea behind it. If I generally know I need to be buying GBP USD, right? In the sense that I know generally I want to be on the bullish side. I just want to see my confirmations. My technical confirmations are not there, so I can't buy it just yet. We still haven't broken structure just yet. But if I generally know I want to buy it, wouldn't it make sense for me to try and get in some type of a sell position a little bit higher, sell it down to my point of interest, and when it hits my point of interest for the buy scenarios, I wouldn't close these sell positions. I would keep them open. I would make them risk-free. I'd break them even, but I would go ahead and buy it there and then. So in a way, when I look at my MetaTrader 4, I'm in one sell position that's healthy in profit, and I just bought the same currency pair with the same percentage risk. There's only a few scenarios that can now take place over here. Number one, the market will go in my direction on the bullish side, which would mean the sell scenarios would be taken out at break even, and I will make money on the buy scenarios over here. Amazing. The other scenario that can take place is this market going the other way. So the buy scenarios are now wrong. The buy scenarios have hit stop loss, but the sell scenarios are still open. I haven't closed them, remember? I might have taken a little partial, but they're still open. Which means as this market is going the opposite way and hitting the stop loss on that trade, the money that I'll make on these sell positions would automatically cover my losses majority of the times. But this has to be an extremely calculated move because done correctly, you're actually managing your risk properly in the sense that I'm covering the risk that I'm taking before I even take it. In a way, I'm about to enter myself into more or less a risk-free scenario. But if not done correctly, what that would result into is one loss over here on the sell scenario and one loss on the buy scenario. So instead of perhaps one win that would cover everything, I would give you a lot of money, you would actually end up with two losses, especially because when it comes to hedge scenarios, the first position oftentimes, if not all the time, is going to be a counter trend scenario. So obviously the sells that we would want to be taking back down over here, this is now going against the bigger picture, the bigger trend, the bigger structure. So we most definitely need to see some very, very, very valid confirmations. Now, going back on the 15-minute time frame, I know what I'm expecting. I know what I'm waiting for. And I'll put this in replay mode as well to kind of show exactly where I started to see this. It was somewhere around here. We've got this screenshot over here. I'll show this to you guys. Before I start to speak about the currency pair taken on March the 9th, currently it's 20th of March, so this was just under 2 weeks ago. And that was kind of the general idea behind it. That was our hourly and the 15-minute range of supply that was identified. And I just wanted to see proof of supply. I just want to see that that area up there is still valid. It's still going to prove as supply to us. So that's generally around that 1.4 region, kind of the reaction that we expected to see. Now, going back on the charts, that's give or take roughly around the same area, so we can have a quick look at it. When I was seeing this counter trend market coming back down, one obvious scenario that I was waiting for would have been a break of this structure point to the upside. So, obviously a break of that structure point to the upside would have been the beginning of potentially this bullish move. More so, a break of this structure point would have confirmed the bullish side. The reason I said the higher one is obviously because even at this stage, this did have the possibility of doing this. It wasn't a very big possibility. This wasn't a scenario that I would have wanted to see happen there and then. At least, it's a scenario that maybe later on, even next week, might come to fruition. So it might end up climbing a little bit higher to close this imbalance before the next leg down, if it is going to go down. But that was, one of the more obvious scenarios that I was waiting for. In a way, for me to buy this, I would have needed to see a break of structure to the upside. If I didn't see that break of structure to the upside, there would have been no point me looking at buys, right? There's no reason me keep analyzing this over and over again. Now I kind of want to see if I can hedge myself into those buys, if I can find a sell position. Again, looking at the markets from a factual way, not from an emotional standpoint. And looking at this from that perspective on the 15-minute time frame, it's kind of easy for me to go ahead and identify that as high, and lower high. Maybe the next lower high is about to be formed, but from that high, we created the low, lower high, lower low. I didn't consider this one as the next lower high, and the reason behind that is because we didn't really get a substantial retracement after that. The major retracement was what took place after this low, and it is quite interesting as to what took place after this low, because we had elements of clear supply being introduced in the market through, number one, manipulation of the highs. That's what took place over there. So as you can see, indeed, it did manipulate these previous highs that were being created within this range. And more importantly, it actually turned into a redistribution or a smaller distribution phase in the market. I just want to remind you how similar this situation is to what we spoke about before, where within this bearish trend, although yes, it's a smaller time frame bearish trend, but on this time frame, within this market structure that's bearish, for this to remain bearish, we need to have supply and manipulations of the highs. The same way for the market to remain bullish, we need to have demand or accumulation and manipulation of the lows. This is the exact opposite, and we are indeed receiving that. We're getting supply through distribution. And as it's creating that distribution, indeed, it is manipulating some previous highs as well. That's one of the reasons I took this high as a major structure point, especially once it created a new low. I would normally want a deeper retracement, a little bit something more substantial to consider that as the major next lower high. But in this case, everything qualified. We did have a new structure point. It was indeed a manipulation of the previous highs. Not that it always needs to be, but that was an extra confirmation. And we moved so quickly and fast away from that level, breaking some of these previous structure points to the downside as well. Now, this is kind of putting a little smile on my face as I'm analyzing it, simply because it's getting ready for those potential hedge scenarios that I was waiting for. The sell scenarios that I would have wanted to take to then later on look to buy it now look a lot more confirmed. Now they look a lot cleaner, simply because there is a whole distribution range over here, and this entire range is actually a redistribution range, but I'll leave that to you guys to go and mark up and study on your own. But now I have got the confirmations that I would want to see. I just want to see my final directional confirmation. The same way in the bullish trend, you would have wanted to see, or I would have wanted to see upon this little pullback over here, I would have wanted to see a break of structure to the upside and then look to trade it. In a bearish trend, as you can imagine, it's going to be just the opposite of that, right? So within the bearish trend, as it's coming down, obviously these little retracements to the upside are going to look like this on the lower time frames. Upon a break below there, I have my final directional confirmation, and I can start to look for sell positions. So as this market is now approaching this area of supply again, this is the picture that we have over here, right? I just want to see proof of supply right now. I want to see that this area indeed is valid as supply, because this can easily, cross above there and start to go higher. Some of you might have even marked this up as an accumulation, preliminary support, selling climax, secondary testing phase B, and maybe you were waiting for this to come up higher and prove to you that it's an accumulation by breaking structure. And by the way, this is why we always want to see a break of structure for accumulation and distribution. Simply waiting for that would have stopped you from taking premature buy positions and losing your money on this scenario. But now I have my area of interest. The rough area that I had marked up was an hourly candle, this final hourly push to the upside. But, it's a rough area. I haven't got my point of interest just yet. I know that we have inefficiency or an imbalance up here. I know that we have had this final push to the upside where it has taken the previous highs, and indeed it's reversed quite impulsively and aggressively back down. So in that rough area, I want to see if we still have supply. So what am I waiting for right now? I'm waiting for the market to, number one, approach my level again, and number two, give me my final directional confirmation by breaking the structure of this counter trend market coming back up. So we can go ahead and identify the major low, major higher low, higher low. This is the next major higher low. And simply, I'm just waiting right now for this market to actually come and approach my point of interest. So as it's approaching that level, as it's actually come into that area that I was waiting for, I'm still not taking the trade over here. At this stage, some of you would be taking the trade, and that's okay. Some of you might be on the 1 minute or 3 minutes or 5 minute time frames, and perhaps you might want to take the trade based on these type of breaks of structure. For me, I just wanted to wait a little bit more to get some more confirmation, as we did have a lot of imbalance up here. So, it did have the possibility of this pushing higher. So I just wanted to see a little bit more of a defined confirmation, I'm going to say. So, at this stage, I'm still waiting. We are in this area of supply. I just want to see proof of supply right now. So we are waiting, and I'm still waiting in these scenarios. I'm still not doing anything. I'm still not executing any trades.
I see the proof, God.
and boom, right over there. This is where now we have challenged this previous structure point to the downside. Again, you wouldn't have necessarily needed to wait this long. You could have indeed taken some of these structure points into account. But for me, the way that I looked at it was this was the lowest point that sponsored this entire range to the upside. So this indeed must be a level of demand down here. And if we break below this level of demand, then my sell positions are most likely confirmed. If this takes place, I can wait for a retracement and start to sell this back down. So now I have the directional confirmation. Now I know that that's an area of valid supply up there. It has indeed broken structure to the downside in my desired direction as well. So now it's time to start to look at entries. This is around the time that I want to start to look perhaps at this final move to the downside and break it down a little bit more and trying to figure out where is it more likely for this market to actually reverse and return to. Naturally, in these scenarios, I would instantly favor a deeper retracement, more of a deeper pullback, especially once it's now come down and challenge these structure points as well. The reason behind it is because I see this as supply. I see this as proof of supply or a recharge of supply, and this supply has now been proven by violating some previous zones of demand, by now taking people out of their trades. Now people have been manipulated out, which opens more positions, which opens more room for the bigger institutions to be able to sell this back down with even larger positions. So it kind of makes sense for a deeper retracement for something like this to, in a way, recharge the supply up there and have more of a strength coming back down. So in these scenarios, I will practically always favor a deeper retracement, and kind of in this picture, it was a little bit clearer, especially as we did have this trend line coming down, which meant loads of liquidity being above this trend line. So this kind of push to the upside to take the liquidity of the trend line to give us that deeper retracement. Not that it was fully confirmed, but it was a little bit more probable. This is normally where I would browse between different time frames. I wouldn't necessarily go to the lower time frames to find my points of interest. I might even go to the higher time frames to find the general area for my point of interest. And then I would start to perfect that more and more on the lower time frames. So this is a bit of a gamble, a bit of a shot in the dark for me to expect this trend line to be manipulated. But that was the analogy that I decided to kind of go based on. And that was the school of thought that I decided to follow with this specific analysis. So naturally, I'm expecting this to move higher, which means I'm probably expecting these highs to be taken for this to push higher. And on the hourly time frame right now, even if you look at the lower time frames, the points of interest above this level most definitely look a lot more attractive, again, from a factual perspective, rather than the ones at this distribution or minor distribution and below it. And the reason I'm saying this is looking at this on the hourly picture, it's a little bit difficult for me to be able to say with certainty that we have areas over here that are left unmitigated. Guaranteed, if I go to the 1 minute time frame, we might be able to find things, but probably the most attractive higher time frame level would be this institutional candle in the middle of the range, right? For this to be mitigated and for this to be taken down lower. But normally that's not a level that's going to be giving us this huge retracement back down, especially since in this case, it hasn't actually left any type of imbalance after it. It's just a random institutional candle in the middle of the range, and it kind of looks like it pulled back to it. So since I'm expecting a manipulation of the trend line, expecting this to push higher, I can probably even say it's going to push higher than there and most likely tap into these previous areas of supply. It's most definitely up there that something has taken place. It was up there that this whole move was sponsored. It was up here that we had the final push to the upside, manipulating the highs. We can see clear signs of imbalance on a lot of time frames. We can see drop-based drop formations. Again, this is an area of supply at the end of the day coming back down. So now my points of interest would be up here. I would be looking at specific points of interest somewhere up there. It was still a little bit challenging and difficult to mark up the exact specific area that I wanted to go based on, especially because the more obvious scenarios would have been taking trades based on institutional candles over here with stop losses being at the high. And not saying these are bad scenarios, by all means, you can go ahead and take these, but I personally knew it was possible to have better risk rewards and smaller stop losses. So I decided to stay patient with this and simply let it play out. This is where I have the directional confirmation. I have the area of entry as well, because I'm expecting the trend line to be manipulated. I'm expecting for us to come back into these rough area up here that is introduced supply. We have institutional candles and imbalances and so on and so forth. And within this range, I'll get my deep retracement. And this is where I would be paying closer attention to it on the lower time frame as it comes up, because you guessed it, as this will approach this level, most definitely on the lower time frames, it will start to create yet another trend over there. And what if I can see that and take the trade based on a break of the structure of that 1 minute trend, for example, the same thing that a lot of people could have done over here. I've just waited a little bit more. I'll do them again. Probably would have better risk rewards and more confirmed trades. So we wait. We wait and we wait. We have our alerts in place. We'll let this play out and do its thing. Once this took place, it kind of made it a little bit more confirmed in the sense that, you know, it's now creating trendline liquidity to the downside as well. When I saw these first two touches, I was like, okay, you know, this is interesting because now this first trend line has been manipulated. We're good. So it did exactly what we wanted it to do, you know, reached above that level and so on and so forth. But interestingly, it's now created trendline liquidity to the downside. So most definitely, this would be scenarios that people would be waiting for. So not 100% confirmed, but it's likely for this to break below this trend line and come lower. Now I have no need of being on the hourly time frame anymore. I've actually already analyzed 15-minute time frame as well. We looked at the 15-minute structure when this market was dropping over here. So I'm mostly now attracted to the 5-minute, 3-minute, 1-minute time frames. But I'm just going to play this a little bit more so it comes to our level before I visit those. There we go. Before we do that, and we can keep it there. So now I want to kind of follow through with this analysis on the lower time frames, such as 5-minute, 3-minute, 1-minute. I've already done the relative higher time frame analysis. We now have everything that we need. We have got that area of supply. We've got proof of supply over here. We pulled back to manipulate the trend line, to fill in whatever needed to be filled in over here and mitigate whatever needed to be mitigated over there. So all of that is done. I now want to pay attention to the final details to then be able to go ahead and execute my trade. And the final detail that was observed was this. This move back down over here was very interesting to see. So once we approached this level again and this started to turn and started to be slow, this was around the times that I started to look for entries, but it wasn't clean enough just yet. It wasn't something that was grabbing my attention a lot. And once this final push to the upside took place, it kind of made sense. You know, we've now yet again manipulated the previous highs, and on the 1-minute time frame, we can indeed look at the structure points within this range to the upside as well. And the way I personally looked at this is on the 1-minute time frame, on the 1-minute trend, this low seemed to be significant. And the reason I say that is that was the final little pullback that we received, the final little consolidation range before this moved up and created the final high over there. To me, that means that we introduced the final bit of demand down here. This market should have remained above these levels of reaccumulation over here as well, if it was planning to go any higher. And the fact that it has now broken below there, I can now see this as a minor break of structure to the downside, which in a way is confirming our area of supply yet again. Now I have absolutely everything. Now the trade is ready. Now we have yet again this final confirmation as well. I did the exact same thing, by the way, the same little, let's say, pullback that we had over here. We are trading based on a break of that structure to confirm that directional bias yet again. We don't need to see all of these confirmations, but I'm going through this slowly and step by step, so you actually kind of get to see my thought process as I'm going through it as well. And this is where we can have a look at the final screenshot taken on March the 18th. At just before New York opened. So this is London time. This is 11 a.m. London time. So we're talking literally just under 48 hours ago. And this is that 1-minute picture that we just saw. That was the break of that minor structure point to the downside that was observed. And as you can see, indeed, we pulled back up and the rough entry area was 1.39931 with stop loss being at 1.39998. And for those of you that might now be wondering as to why I marked up that specific level up there and why, for example, I wasn't interested, let's say, in the imbalances down here or this bigger institutional candle in the middle of this range and so on and so forth, one simple reason. Where was the break of structure sponsored by? Now, this is something that I will have to go into a lot more information about it later, but generally speaking, especially looking at this on the 15-second time frame, it was in a way this redistribution that sponsored this break of minor structure point to the downside. So this entire move from up there and especially this redistribution were the reasons why this market adapted to this bearish move back down, which meant that can prove as a future area of supply up here. Previously, we had introduced supply up there. So we can indeed be doing that again at this drop-based drop formation at that area of supply. Now, I don't normally want to, take my trades at the bottom and put my stops at the top. Sometimes we do that with institutional candles, but within this range, it doesn't really make sense to do that, if that makes sense. So I would just want to see the market in that level. I'm not waiting for any more confirmations. Once it reaches my level, once it reaches that kind of desired area, I would go ahead and execute the trade. I'd go ahead and pull the trigger there and then. And it's just a matter of where I would want to place my stop loss. This is where mostly the second base time frames kind of came into place. And I personally decided to have my stop loss right at this structural high on the 15-second time frame. And the reason I put it over there Some of you, again, may be wondering, why did you have your stop loss here? Why not up here, or maybe a few pips above, and so on and so forth? When you're looking at low stop losses and high risk to rewards, the difference between 2 or 3 pips can literally be the difference between you catching a 1 to 20 risk to rewards and you catching a 1 to 50, 1 to 60, 1 to 80 risk to reward. So not that I always want to have the smallest stop loss, not that I always want to have the sniper entry, but I always want to perfect my trade to the best of my abilities, as long as it's not based on emotions, as long as it's based on facts. And the fact that we have over here is this is my fractal structure points. That's high, low, lower high, lower low, in a way, lower high, lower low, so on and so forth. So if I am to take the trade based on this structure point, based on this lower high, based on this redistribution of the price, then my trades are probably going to be invalidated if this market crosses anywhere above that structural high, which means I don't necessarily need my stop loss up there. It doesn't make that big a difference in this specific case, but you can imagine if you're looking at different pairs, different time frames, that little difference can literally be 5 pips, 10 pips, 20 pips even, and that makes a big difference in your stop losses. Now, funnily enough, I'm in these trades, I've executed them, but I'm still thinking that this is a hedge scenario. So remember, I still want to buy this. I still want to be on the bullish side of it. So I've sold it up there to then be able to buy it later on. So now I want to find areas of take profit or areas of significance for me to manage my trade properly. I instantly know that I'm targeting below that trend line. So practically none of the stuff that happens before that I care about. None of these stuff is going to throw me off. I would not, and I did not actually see this as a break of structure to the upside. That was a clear manipulation. That was a clear, in a way, sign to give us re-entry opportunities. I'm not going to go into detail about these specific re-entries over here. This video would be way too long if I want to cover this as well. But generally speaking, I know I'm targeting below the trend lines. That's the first thing on my mind. First, we got to take the trend line. We got to manipulate the trend line. So practically, I would start to look at this around here. Obviously, before that, we kept an eye on it to, in a way, take the other trades. But I would manage these trades practically once we've taken the trend line. That's where I'm targeting. That's where I know this market is likely to go. And the risk I'm taking is based on that. So if I'm wrong, I'm willing to lose my money because that's a risk I'm willing to take. So instantly, I know I'm targeting below the trend lines, and I can see that we do have a big amount of imbalance and unmitigated institutional candles down there. So this would make that entire range a point of interest for the buy side, and it looked good. Why? Simply because that would have been a manipulation of the trend line. That would have been a rejection of that point of interest. You know, it's quite nice to see that. So I was getting ready to look for buy scenarios along that range, where as we started to approach this level more and more, I was unsure about this trade, and it didn't really result in it being a trade scenario that I wanted to take. It approached that level quite impulsively. It didn't really give us any signs of lower time frame reversal, so there was no need for me to, in a way, want to take partials on these sell positions. There was no need for me to want to look to buy this. I decided to remain in these sell positions and keep them open. I'm not sure exactly, but I think this is now floating at something like a 1 to 23, and this is at 1 to 17, which is phenomenal within a space of 48 hours on an intraday basis. And these are trades that I still have open. I have actually kept just under 100% volume over the weekend. So in a way, stop losses are covered. All of these stuff, a small portion has been closed, but majority, over 95% of all of these positions are actually still open, still running. And I'm keeping these open over this weekend as I'm talking right now, because again, I know the risk that I'm taking. I know exactly kind of what I'm expecting. I also know that this level that the market is hovering around right now can indeed qualify as a price reversal zone. That could be, again, an imbalance, an institutional candle, generally a point of interest. So I know the risk of the kind of new week starting with a very bullish GBP USD. Knowing these stuff, I still decided to keep this open over the weekend, because worst case scenario is this market reversing without me and taking me out at 2, not break even, but 2 small profit trades, which is something that I'm comfortable with. But the other scenario is still what I'm going to be chasing throughout next week and the week after, in the sense that I plan to keep these sell positions open until proven otherwise. If I can get in some buy positions with GBP USD, simply because the structure is on our side, I would be following that. But something that's kind of very obvious to me as well is this move that we had down here, which manipulated these lows, created that imbalance that was never closed, and sponsored this entire range to the upside. That area as an area of demand is extremely attractive, hence why I have put the final take profits just above this level, just before we approach it. I do have a hunch that we can be approaching this level, especially before having the next leg to the upside. It kind of makes sense for us to approach this level. That's why I want to keep my sell positions open. But as of right now, you know that I wouldn't necessarily be too interested in the points of interest back here. I would just want to keep an eye on them, exactly what I'm doing right now. More so, I'm waiting for the structure to prove me wrong. So once this bearish structure starts to turn around and turn bullish, that's around the time that I'll be looking for entries, as long as I have the full confirmations followed with it. Now, I don't want you necessarily to watch my videos and adapt the exact trading style that I have right now, because the trading style that everyone adapts depends on a lot of different things. Mostly it depends on your lifestyle and on your other commitments as well. So you don't have to duplicate exactly what I do, but take elements of what we have spoken about to hopefully little by little be able to apply to your analysis, and little by little be able to see better results. Don't overcomplicate it. Don't overanalyze it for yourself. Again, know that we always speak about patience, so be patient, both in your learning and in your earning, especially when it comes to this style of analysis. Now you see how much I wait before I take the trade, but the trades that are being executed are successful ones. They're going in our direction. They're following exactly what we wanted to do, which makes the wait worth it, which makes it even worth it to not have to necessarily execute a trade in the same week or multiple trades within the same week. So patience, patience, patience. Also, when it comes to hedging, please stay away from hedging. Stay away from what I just spoke about unless you have experience in the financial markets. It's not something that I recommend beginner traders or beginner smart money and wipe-off traders to get into. Please give yourself more time with the idea of hedging. There's so many things you have to take into account, especially since it's a counter trend scenario, since you're going against the major trend. But little by little, start forward testing it and start learning it. Remember what we spoke about over-analyzing a pair. If you feel like you're analyzing it way too much, simply move on to the next currency pair and use alerts to stop yourself from looking at the charts 24/7. Do you think I'm going to be monitoring this pair until it reverses from all the way down here up there? No, of course not. I'm going to be setting an alert up there, and whenever my alert goes off, I open my laptop, I check it. If need be, I'll monitor it. If not, I'll set another alert until it comes closer to my point of interest. Use TradingView alerts or whatever alerts that you're using in your favor. The TradingView alerts can help you so much with trading psychology and trade management. And the final thing I'll add in regards to this before I speak about the next video and exactly what I meant at the start of the video is that it makes sense to have access to a community of traders that are trading the same way as you. It doesn't make sense to be in a community of beginner traders that everyone is trying to learn the same thing, but it makes sense to be in a community of traders where you have people around you who are trying to learn with you, but you also have professionals next to you that can answer your questions, that can hold your hand in the journey, that can help you. We are talking about the biggest financial market in the world. So please understand that it's a little bit more complicated than you think. You need that community of people around you. You need to be able to have access to a wave, to an ocean of traders that are thinking the same way, that have the same goals, that will be keeping you on your journey. And that's indeed the catalyst for the success of a lot of people that we work with as well, the community around them, the people around them that will help them in this journey. But this now brings us to a conclusion of market structure part 2. As explained in the previous video, I wanted to help you to understand where we are going to be.
All right, that's market structure part 2. Any questions? All right, yeah, I guess y'all are prepared to be rich. You're prepared to be rich.